Bloomberg Audio Studios.
Podcasts, radio, news.
Lizanne Sonders joining us right now, Chief Investment Strategist over at Charles Schwab. And Lizanne, what was most surprising to you? What we learned from the Fed today or the market's reaction to it?
Well, the market reaction was quite extreme. I don't think that this was a big surprise. We actually were of the view that there was justification for the Fed pausing at this month's meeting today. Now, expectations were such you were at about a 98% probability. You had the Timorous article that came out suggesting the Fed was going to do something. But it was, I think, pretty easy to expect a hawkish cut given stickiness in inflation and relatively resilient growth. I guess what the market reacted to was the cutting in half of the number of rate cuts expected in 2025, not to mention the fact that you had a dissent this time. And it was an interesting dissent because, it's a brand new president in terms of the Cleveland Fed. So it was an extreme move on the downside. But we were already seeing a lot of churn and weakness under the surface, really since the election. It's just masked by until today, strength by the Mag 7.
Right, and just took out the legs from them, and then there you go. Now you have negative breath versus positive breath at the end of the day. Lizanne, it was clear from the presser that there were some Fed officials who were looking at potential policy changes as a way that their economy and growth and inflation forecast was shaping up for next year. How then do you manage your asset allocation when there is so much confusion?
Well, it's not just confusion around the path of Fed policy, but confusion around government policy. And that there were so many reporters that tried to flesh that out from Powell, but he's in a position much like the rest of us, which is, the ultimate shrug emoji, because particularly in areas like immigration, like tariff, and the playbook that we have from 2018 with regard to tariffs, we just don't know when the announcements are going to come, whether this truly is a negotiating tactic or whether they will go to the extreme. It's hard to argue against the idea that tariffs, all else equal, put downward pressure on growth. They put upward pressure on inflation, and that arguably is something that came into the mix in terms of summary of economic projections, and the bias now much more in favor of the risk of higher inflation relative to lower inflation. And that was a big switch from the September dots plot and summary of economic projections. So I think that was embedded in market weakness today too.
I love the fact that you brought up the shrug emoji, because Alex and I were saying there are so many of his answers pretty much amounted to that. When it comes to the Fed's inflation target, he clarified that it is still 2%. It's not 2.5%. It's not 2-ish%. What is your confidence, though, that that's what is going to stick with, given that there's so many things that are evolving and will evolve in 2025?
I don't. It's hard to have confidence in a metric that is at least near term likely to be driven by government policy, particularly tariffs. Yes, I mentioned the 2018 playbook. The difference, of course, is that in 2018, the pro-tariff folks will say, well, it didn't lead to inflation. Well, they were much more targeted. They tended to be in intermediate goods. They were much shallower in terms of percent, and we didn't otherwise have an inflationary backdrop. Obviously, a very different situation today, not to mention broader, larger tariffs targeted on imports from multiple countries. What we did see in 2018 is that tariffed goods did see a big surge in inflation relative to non-tariffed goods. But we just don't know what 2025's playbook is going to look like. But again, it's hard to argue that the bias isn't up, at least near term, in inflation. Trying to calibrate policy, and to the first part of your question, trying to trade from an asset allocation, tactical or otherwise, around that, I think it's a really tricky exercise. I think you want to sort of stay close to your sort of benchmark strategic asset allocation weightings, but really take advantage of volatility for maybe portfolio-based rebalancing as opposed to waiting for the calendar to dictate rebalancing.
And then that gets into the idea, Lizanne, as to whether looking through some of these issues, meaning the uncertainty around the Trump administration, the potential volatility, and obviously the potential inflationary impact. I deride Jay Powell for saying he's looking past it. Maybe that's what he has to say. But is there a case for investors to indeed look past it, certainly if you're a bottom-up stock-picking type of person?
Well, again, there's the timing issue. So with regard to tariffs and immigration, that can be done via executive order. So that is near term. There'll be some point where we have more clarity and we can start to look past that, particularly to the end of the year where you have the potential to start to see some more of the pro-growth policies, whether it's on the tax front or the regulatory front. Those require congressional approval, though. So we're talking about different animals here in terms of timing and in terms of the process. I think what we are likely to see is a focus on fundamentals, that connectivity between fundamentals, quality-based fundamentals, trajectory in terms of earnings, exclusive of any variability associated with government policy. I think that's where the focus is likely to be, is where will those fundamentals be maintained with that growth bias, with that profitability, strength of balance sheet, interest coverage, exclusive of concerns about policy uncertainty.
So, Lizanne, where does that leave small caps and mid caps?
Well, I think the move up from, sub 3.8 to more than 3.5 on the 10-year today was certainly a big part of why you saw the big turnaround in small caps to the downside. Many smaller companies, particularly the zombie companies, there's more variable rate debt, and they are more at the mercy of what happens on the long end of the spectrum. And I think that will continue to be the case, that small caps will be at the mercy of the move in the bond market. And so I think you have opportunities, but what we have been saying is when you go down the cap spectrum looking for opportunities, do not sacrifice quality. We had a low quality trade that kicked in the last month or so. We were saying fade that low quality trade down the cap spectrum. If you're going to go down the cap spectrum, absolutely stay up in quality.
So, Lizanne, at the end of the day, how much do you read into today's sell-off in stocks and bonds, and does it set the tone for the remaining days of 2024?
Well, there was some signs of some churn under the surface. If you look at the NASDAQ, obviously the market has done really well since Election Day, but the average member maximum drawdown within the S&P is negative 9% just since the election. It's negative 21% in the NASDAQ just since the election. And that doesn't include today. So we were seeing some underlying weakness. It was just masked by what the cap-weighted indexes were doing. I think that type of churn under the surface could continue. We may continue to see some catch down by the recent sort of high momentum leaders. I would look for the point where you start to see some grinding better performance under the surface, much like we started to see back in the mid-July period of time. So that's what I'm keeping a close eye on as we go through this process of weakness, even if it's only a one-day phenomenon. I have no idea whether that's the case.
Well, but that kind of circles us back to corporate earnings, Lizanne. I mean, you mentioned what we saw earlier this year when some of the same fears materialized, and then when companies started to report, at least the larger cap companies, all was well, relatively speaking. And I do wonder if maybe we see a repeat of that where people do rush back to some of those big tech or just big cap names, not just tech, but big cap names, those that have proven to have the cash flow, the revenue, and of course the profitability to justify their valuations.
I think you're right, Romaine. It's not just profitability, but profit margin. So expectations for calendar year 2025 earnings, both for the S&P, but also down the cap spectrum in an index like the Russell 2000, are relatively lofty. In the case of the S&P 500, those fairly lofty double-digit kind of gains in earnings are predicated on record-breaking profit margins. The good news is that forward 12-month profit margin estimates continue to go higher. If that is maintained and you continue to see decent productivity numbers, then I think you're okay in those segments of the market where you've got that profitability profile. But I think you're right. I think that trajectory of profitability, and in particular, maintenance, if not growth in profit margins, is really key to the story in 2025.
All right, Lizanne, really appreciate your joining us today. Fantastic insight from Lizanne Sonders, Chief Investment Strategist over at Charles Schwab on this sell-off.